So as the book closes on another financial year this Friday, millions of proactive Aussies will be ready to hit submit on their tax returns in the hope of a fast, fat refund from the ATO. But perhaps there's a few things you should consider before rushing out your return. To discuss more, we're joined by the Director of Tax Communications at H&R Block, Mark Chapman. Mark, welcome to the Savings Tip Jar.
It's a pleasure. How are you?
Yeah, we're doing very well. Thanks, Mark. With June 30 sort of fast approaching, there's a lot of talk about a few changes in the personal income tax refund landscape. So are there going to be any surprises for salary earners when they lodge this year's tax return?
Well, there is a potential surprise in the sense that the low middle income tax offset won't be available this year. So for the past few years, if you earned up to $126,000, basically you've been entitled to that offset, which could potentially have given you up to $1,500. If you earn between $48,000 and $90,000. However, that was abolished at the end of the last tax year. But many taxpayers won't actually have appreciated that, because the way the low and middle income tax offset actually works is that it's actually given when you lodge your current year tax return. Therefore, the first that a lot of people will know about this is when they go to lodge this year's tax return and the offset isn't there. So it is worthwhile pointing out that offset has gone. If you earn less than $126,000, you will notice the difference, and potentially there will be quite a significant difference.
Yeah, certainly could come as quite a bit of a shock to those people that become quite accustomed to receiving a tax refund of over $1,000 for the past few years. But just a little bit on that similar theme, Mark, what are your top tips for this tax season for people maximizing their refund or on the other hand, minimizing any potential tax debts?
Well, basically, you've got to claim everything that you're entitled to. So in terms of work-related deductions, if you basically spent the money, as part of your job, and you can prove that you spent the money, so if you've got the substantiation, the receipts, the expenses, etc., then generally speaking, you can claim a tax deduction for that item. So it is worthwhile claiming everything that you're entitled to claim. However, obviously don't embellish deductions. So the ATO has a particularly close focus this year on work-related expenses. So make sure that you that there is actually a connection between the expense and the deduction, that you've got the proof that you actually spent the money, that the expense hasn't been reimbursed, and just make sure that you're not over-egging the pudding. Those are probably the two key tips. Third one basically is to make sure you've got all your records for every deduction that you're going to claim. The receipts, the invoices, the credit card, etc. Because if you don't have those, and the ATO come along and audit you, then basically your deductions will be kicked out of the park, and you won't be able to lodge a claim. So it is worthwhile spending some time now, getting your ducks in a row, going your paper, making sure that you've got everything that you need, potentially getting in touch with retailers if you haven't got the receipt, and obtaining a duplicate, because it will pay dividends when you come to do your tax return for this year.
Sure. And kind of what you were saying there, a lot of people, in this post-COVID world are kind of working from home still, whether they spend some time in the office or they spend all their time at home and what have you. But one major change that has, sort of come and gone now is the 80 cent per hour flat method. That's now gone. And it's been replaced with the 67 cent per hour method. Is this still worthwhile, or should people who are working from home opt for the actual cost method where there might be a bit more effort involved?
Look, it's generally worthwhile claiming actual costs if you actually can do that. Having said that, the substantiation requirements with the actual cost method are very cumbersome. You've got to keep a record not just of the individual expenses, but also of the split between work use and private use. So you basically got to know how much of your home is actually your home office. So it does get very, very complicated. And frankly, not that many taxpayers do claim the actual method, even though that does tend to produce the biggest deduction. So your only alternative now, unfortunately, is the 67 cents per hour fixed rate. You're quite right. The 80 cent shortcut rate was abolished at the end of the last tax year, or as indeed was the 52 cent fixed rate. So they were rolled into this new 67 cents per hour fixed rate. The mix of items that you can potentially claim has changed. And in addition, there are substantial, there are quite beefy substantiation requirements to actually prove that you're entitled to the claim. All of which are likely to act as a bit of a disincentive to basically anybody who wants to claim for working from home expenses. So, particularly taxpayers may not have been aware that this change has actually happened. The first they may well know about it is actually when they go in to see the tax return to claim a deduction, and therefore you've got to be prepared. You've got to have the proof of the number of hours that you've worked during the year, proof of expenses, all of which is likely to be a significant disincentive, I think.
Mark, every around this time every year, we seem to be bombarded with a lot of marketing and advertising from the likes of Officeworks going on about some of the top items that you should consider buying this end of financial year to take advantage of. What are some of the top last minute end of financial year purchases that you can list off that people perhaps didn't know they could claim the cost for?
Yeah, well, I mean, the first thing to note is that if you actually want to go out and buy something, basically you've left it very late. You've only really got 3 days to go out and make any purchases. It is worthwhile going out and spending, as you say, on items of stationery or capital equipment. However, you need to bear in mind that you only get the tax back. So for every dollar that you spend, you only get your actual tax rate back, which could be 19%, 37%, 45%. But you can see that there is actually a significant cost involved. You've actually got to spend $1 to get potentially 37 cents back. Having said that, when you're this late into the tax year, there are actually a couple of tax planning ideas which are worthwhile bearing in mind for taxpayers who've actually got the cash. They've got some cash sitting in their bank. They're just burning a hole there, and they don't know what to do with it. So, for example, you could pay a personal superannuation contribution. You can claim a tax deduction for concessional superannuation contributions. So, you can claim up to $27,500 in concessional contributions. Obviously, that includes the amounts which your employer has already paid, and in addition, any salary sacrificed amounts. But any surplus on top of that, up to the $27,500, basically you can claim a tax deduction for that. So that's definitely worthwhile. Having said that, the payment has got to be with the superannuation fund by June the 30th. So, you've got to make sure that the payment has actually cleared your personal bank account and it's hit the superannuation fund by June the 30th. In addition, if you've got some investments which are currently sitting at a loss, a capital loss, and you know that you've already crystallized some capital gains earlier on in the year from selling a property or some shares, etc., you could potentially look at liquidating those loss-making assets and offsetting the loss against the gain, and making effectively the capital gain go away by matching the losses against the gains.
For sure. And we'll move now to another kind of hot talking point at the moment, and that's the advent of scams and tax scams. So what should taxpayers be on the lookout for in regards to, tax office scams and things like that? And what should they do if they think that they've been targeted, or if they think they've actually, lost money to a scam?
Yeah, well, you're absolutely right. Not only are we entering tax season, we're also entering tax scam season. So the scammers are basically fully aware that taxpayers are now concentrating on tax. So therefore, there are lots of phone calls, emails, SMSs from these scammers going out to people, either offering, the prospect of a big refund, which they didn't know they're entitled to, or alternatively, there's some scammers who are actually phoning up taxpayers and basically threatening them with legal action unless they pay an amount supposedly to the ATO. It's not really to the ATO, of course. It's to the scammers. Basically, if it looks and sounds too good to be true, it probably is. So the ATO, for a start, the ATO won't contact you and basically threaten you with legal action. They don't demand money with menaces in that fashion. So make sure if you get a phone call from the ATO threatening, those sorts of measures, that you do actually phone the ATO back and check that it is genuinely somebody from the ATO ringing. If you get an email or a text and there's a dodgy link within it, the ATO doesn't send hyperlinks, so the chances are it's a scam. Don't click on it, because he could be threatening the security of your device. He could be letting the scammers take over your device. Don't include your credit card details in any online form, because you could potentially lose control of that. And just be careful. As I say, if it seems too good to be true, it probably is. There will be lots of scammers around over the next 3 or 4 months. You just got to be on your game and spot them and take action if necessary.
I suppose you could say, some things can seem too bad to be true. I mean, I've certainly received a few voicemails myself, apparently from the ATO, saying there's a warrant for my arrest. So I hope that's not true. But just moving on.
Almost certainly not.
Yeah. So I just wanted to move on to a slightly different note here, and just talk a bit about the stage 3 tax cuts, which are due to kick in from July 2024. I know you've previously expressed strong views about why you feel these cuts should be binned. So just amid the current warnings of a possible recession on the horizon, I just wondered, do you still hold these views? And if so, why?
Well, I do still hold those views. Having said that, we're now we're now pretty much 12 months away from the time when the tax cuts are due to come into force. The government isn't looking like they're going to back away from these tax cuts. So therefore, I think we need to operate on the basis that they probably will come into effect on the 1st of July next year. So really my opinion about it is neither here nor there. It is probably going to happen. I mean, in the current environment, I don't really think that the tax cuts as they're originally legislated are affordable. But having said that, the government has pretty much locked themselves into doing it, and therefore we'll just have to find a way around that.
For sure. And I detect a hint of a Midlands or Northern accent there, Mark. So
Manchester.
Yeah, Manchester. There we go. So how was it when you moved over personally? How was it navigating the sort of Australian tax landscape? And are you currently? It looks like you're working from home right now, and so are you claiming some work from home expenses on this call?
Getting quite personal.
Yes. I work from home. I work from home full time these days, so yes, I'll be claiming the 67 cent rate. I can't be bothered doing the compliance.
That's from a tax man. Yeah.
Yes, exactly. That's just how complicated it actually is. But yeah, when I moved across from the UK, it was obviously a big shock. We didn't traditionally have to do tax returns within the UK unless you earned a large amount of money. So therefore, moving across to Australia and having to do one every year was basically quite a shock. Also, because the tax system's completely different. There were all of those issues to deal with. So yeah, it was a bit of a baptism of fire. It's a good job I was actually involved in the tax profession anyway, and therefore it's probably a little bit easier for me than for most people.
And just finally, Mark, we know that every year the ATO releases a bit of a hit list on people that they're targeting, or certain practices that they're targeting this end of financial year. So for this year, do you know who's on the ATO's hit list and why are they targeting these people?
Yeah, well, as I alluded to earlier on, work-related expenses are very much on the ATO's hit list. The ATO thinks that there are lots of people claiming lots of deductions that they're not entitled to, or that they potentially are entitled to, but they're claiming them incorrectly. The work-related expenses, it has been mentioned by the ATO. So it is slightly cheeky that they're basically going to be checking those so closely, given that they were the ones who caused the confusion in the first place by changing the rules. Nevertheless, there we are. But apart from the work-related deductions, the ATO are also targeting property deductions. So if you've got an investment property, a holiday home, etc. So the ATO, first of all, wants to make sure that you're actually declaring the income from that holiday home or investment property. And in addition, they want to make sure that you're claiming the deductions in relation to that property correctly, particularly the loan type deductions, the mortgage interest. The ATO thinks that there are lots of people who are potentially claiming deductions for their family home, which aren't allowable. So they are going to be looking at those quite closely. To assist them in doing that, they've actually got some third-party data. So the financial institutions have provided data on all of their lenders, on all of their borrowers, the properties that they own, the amounts of interest that are being claimed. So therefore, the ATO has a way of verifying the amounts that are actually included in your tax return. And finally, the ATO is also targeting capital gains tax in relation to assets such as properties, shares, cryptocurrency, etc. Because the ATO believes that there are lots of people who aren't necessarily disclosing capital gains. So they are having a real push around that.
Sure. Mark Chapman, that's all we have time for on the Savings Tip Jar podcast. Thanks for joining us and sharing some of your expertise there.
Thanks so much.
Pleasure. Thank you.